Welcome. In this video will the attack start for Zbcn coin. We will analyze it. Don't forget to subscribe, like, and please watch to the end to understand.
To understand what an ascending curve structure means in technical analysis and what kind of scenario might develop if the price touches this curve and bounces off, we first need to examine the role such curves play in market psychology. An ascending curve is often the visual expression of a long-term trend and is essentially the result of investors gradually beginning to accept higher price levels over time. This curve indicates that price movements are gaining upward momentum and that buyers view every pullback as an opportunity to re-enter the market. At this point, the price touching the curve is interpreted as a critical signal, because this touch is seen as a test of whether the trend is still strong. If the price reacts upward when it touches the curve, it reveals that buyers are still supporting the market and that the uptrend can continue in a healthy manner. The price touching the ascending curve and bouncing upward is generally considered a trend confirmation in technical analysis, because when the price touches the curve, even though sellers exert some pressure, the majority of market participants see these levels as a buying opportunity, pushing the price back up. Since this signals the continuation of the trend, it becomes a reassuring sign for both short-term traders and long-term investors. As long as the curve continues to slope upward, the price repeatedly finding support near this curve strengthens the persistence of the uptrend. At the same time, the price touching the curve also refreshes investors' confidence psychologically, because each bounce demonstrates that buyers remain strong and are resisting sellers' pressure. Especially in bull markets, price movements touching the ascending curve are read even more positively, because by nature, a bull market has an upward tendency, creating an environment where investors are waiting for opportunities at every pullback. The price reaching the curve and bouncing from there both increases the confidence of new investors entering the market and reassures existing position holders that they are moving in the right direction. This can lead to increased trading volume, stronger buying pressure, and a faster upward momentum in price. Furthermore, the bounce from the curve is also visually perceived as part of a strong bullish formation, reinforcing the idea among technical traders that the trend is continuing in a healthy way. Another important point is that the price touching this curve generally tends to form higher lows. Higher lows are one of the fundamental indicators of a trend, because even when sellers try to push the price down, buyers lift the market above previous low levels. This shows that the market is strongly under buyers' control. Therefore, the price touching and bouncing off the ascending curve is not just a technical signal, but also an indication that the market is moving forward in a healthy and stable manner. Buyers becoming active at this stage accelerates price movements. Especially since institutional investors also closely monitor such structures, these points where the price touches the curve often become areas where large volume purchases occur. From a psychological perspective, this situation also plays a major role in shaping investor behavior. When most investors see a clear ascending curve and notice that the price is approaching it, they tend to open positions with the thought that a reaction will come from here. This creates a self-reinforcing mechanism, because if many investors focus on the same technical level and act with a similar expectation, the likelihood of the market reacting there increases even more. Thus, the bounce from the curve becomes not only a technical phenomenon, but also one reinforced by the collective behavior of the crowd. This is important to understand how market dynamics work, because technical levels are often not just lines, but reflections of collective investor psychology. The price bouncing off this curve also signals the potential for the trend to accelerate, because with each bounce from the curve, investors' confidence is reinforced and more participants join the rally. This can cause the price to advance upward at a steeper angle. It is especially common for the price to move sideways for a while after such bounces and then make a sharp upward move. For investors, this process offers both short-term profit opportunities and contributes to the strengthening of the long-term trend. If the price continues to react upward every time it tests the curve, the reliability of this visible structure on the chart increases further, and investors start to consider these points as golden opportunity zones. Of course, the price bouncing from the curve is not just a temporary reaction, but often the beginning of a broader movement, because such ascending curves frequently form the foundation of major rallies. The bounce from the curve signals that the market is not yet exhausted, that buyers are still strongly supporting it, and that the upward momentum is being preserved. These movements can lead investors to increase their positions and focus on longer-term targets. Additionally, when the price touches the curve and rises again, it attracts new investors' attention, leading to increased liquidity. As liquidity grows, the price is able to move faster and more strongly. In conclusion, the price touching and bouncing off the ascending curve is regarded as a very positive and reassuring structure in technical analysis. It signals that the trend is healthy, that buyers are strongly supporting the market, and that the upward tendency is likely to continue. When investor psychology, technical signals, and market dynamics align, such structures can be precursors of major rallies. Each bounce further reinforces the upward trend and leads investors to follow it with more conviction. Therefore, ascending curve structures are not just technical drawings, but also strong indicators of the overall market direction, participants' psychology, and the strength of the uptrend. But we can't rely on the curve alone to make an analysis, so let's take a look at other metrics as well. Stay tuned.
In the MACD indicator, an upward crossover is an extremely critical signal in terms of technical analysis, because this structure can be a harbinger of a fundamental change in the current trend dynamics of the price. This crossover, which investors and traders closely follow, indicates that buyers are regaining strength. Seller pressure is starting to weaken, and the price may gain momentum toward a new upward trend. The MACD consists of two main lines. One is the MACD line, the other is the signal line. The relationship between these two lines allows a comparison of the market's short-term momentum with its long-term trends. In the case of an upward crossover, the short-term momentum begins to surpass the long-term trend. In other words, the market enters a process where sellers are losing power and buyers are taking control. This process often signals the beginning of a new rally because it also increases investor confidence psychologically and leads to a rise in trading volume. Especially if this crossover occurs during a phase where the price is recovering from bottom levels, market participants perceive it as a strong bullish signal. The importance of this crossover is not only connected to mathematical formulas, but also to investor psychology. In the markets, prices do not move solely according to the mechanical balance of supply and demand. The expectations, fears, and hopes of investors also shape price movements. Since an upward crossover in the MACD is perceived as a positive signal by most investors, the signal itself can contribute to the upward movement of prices. In a sense, this crossover both technically signals a real trend reversal and becomes a psychological factor supporting the price through market participants' perception. Therefore, this situation creates a chain reaction, triggering upward momentum in prices. This momentum can accelerate further, especially when large investors join in, leading to sudden price surges. After such a signal, the price performance usually begins with small-scale increases. Initially, early buyers push the price upward, and then other investors notice this movement and join the buying. This gradual participation strengthens the upward movement of the price. These chain reactions of buying after a MACD crossover support the upward price movement while also causing a noticeable increase in trading volume. A rise supported by volume is generally a sign of a lasting and healthy trend because trading volume reflects investor interest and confidence in the market. A high volume rally indicates that the price will not easily reverse and that buyers have seriously begun to control the market. At this point, the upward crossover in the MACD ceases to be just a signal and becomes a force that concretely shapes price movements. This upward crossover also changes investors' risk perception. In a previously bearish or sideways market, investors usually act cautiously and hesitate to open positions. However, when an upward crossover appears on the MACD, many investors consider it a safe entry signal. This confidence lowers the market's risk perception and brings more investors into the market. As a result, new liquidity enters, which further accelerates the upward movement of the price. Especially since large funds, institutional investors, or professional traders.
One of the most exciting and eye-catching parts of Elliott wave theory is undoubtedly the third wave. This is because the third wave is considered the strongest, most liquid, most participatory, and most noticeable wave in the Elliott wave structure. The first two waves are often marked by investor indecision, hesitation, and prevailing uncertainty in the market. Especially in the first wave, even though the price begins to rise, no one fully trusts this upward move. In the second wave, the price gives back part of the gains from the first wave, and at this point, most investors still struggle to determine which direction the trend will continue. However, when the third wave begins, market perception changes fundamentally. The vast majority of investors recognize that the price is moving upward and that a new trend is forming. For this reason, the third wave is not only technically important, but also psychologically represents the breaking point of the market. This is why, as you mentioned, the expectation for the price to reach the 2.272 level at the start of the third wave is so important. In Elliott wave principles, the most fundamental rule of the third wave is that it is never shorter than the first wave. In other words, if the price has traveled a certain distance in the first wave, it is natural for us to see an even greater rise in the third wave. Most of the time, the third wave extends to 1.618 times, 2.618 times, or even more of the first wave's length. For this reason, when setting targets for the third wave, Fibonacci levels come into play, and the expansion ratios starting from 1.618 are typically considered. The mention of a more advanced level such as 2.272 indicates that the upward move carries truly strong potential. Now let's focus on the 2.272 target. This level is one of the standard Fibonacci projections of the third wave and reflects the momentum of the price. If the price reaches this point, we not only get a technical confirmation, but also see a significant psychological boost in the market, because the third wave is the point at which the majority of investors realize that the trend has really begun. Therefore, as the price moves toward the 2.272 level, it attracts new buyers, strengthens the confidence of existing buyers, and greatly reduces selling pressure. This creates a self-sustaining cycle of upward movement. When this rise occurs, an expected increase of around 80% is actually very consistent with the nature of the third wave. This is because the third wave is known as the phase where prices move most sharply and investors realize the largest gains. For example, the first wave may only offer investors a small return, while the second wave often discourages them. But in the third wave, things change. At this stage, the price accelerates dramatically and significant percentage gains occur in a short time. For this reason, an 80% rise is highly reasonable from both a technical perspective and in terms of overall market behavior. One of the reasons the third wave is so strong lies in the natural mechanics of crowd psychology. In the first wave, only a small minority believes in the rise. They are usually bolder, more risk-tolerant, or those who can spot the trend early. When the price pulls back in the second wave, most people say, "The rise is over." But when the third wave begins, the large group of investors who have been watching the first two waves and waiting on the sidelines step in. Their buying pushes the price even higher. Thus, the third wave becomes a powerful factor not only in technical analysis, but also in investor psychology. Reaching the 2.272 level also gives the investor strong confirmation. This point shows that the price has not just made a small bounce, but has launched a serious trend. The strength of the trend is thereby validated. This validation multiplies investor confidence and leads to more funds flowing into the market. Often in the third wave, not only retail investors, but also institutional investors start taking positions. The entry of institutional investors increases volume and makes price movements much stronger. The structure of the third wave is generally fast and uninterrupted. Corrections are very short and shallow. Even if the price pauses briefly, it quickly regains its upward momentum. This is one of the most critical factors in realizing the 80% rise. In the third wave, investors rush to avoid missing the opportunity. The buying appetite becomes so intense that the price is not allowed to stagnate. Every pullback is seen as a buying opportunity, which continuously pushes the price higher. Now let's examine the 2.272 level more technically. This level is one of the common Fibonacci extension targets for the third wave. The size of the first wave is measured and then added to the low of the second wave to calculate the possible targets for the third wave. Most often, 1.618 is the most common target. However, in stronger trends, moves extend to 2.272, 2.618, or even 3.618 levels. Therefore, reaching the 2.272 level signals not an ordinary rise, but the start of a powerful trend. Such trends may not only offer short-term gains, but can also herald a longer-term uptrend. An expectation of an 80% increase is not surprising, especially in the cryptocurrency market or other highly volatile assets. In dynamic and high-risk markets like crypto, third waves have repeatedly produced such large moves. The important point here is that third waves often present the biggest profit opportunities for investors. Thus, reaching the 2.272 level provides not only technical confirmation, but also opens a significant window of profit for investors. In addition, the third wave is usually one of the most liquid periods in the market.
For the price to reach the 2.272 level, not just a small group of investors, but a very broad base of buyers must step in. This in turn brings about a stronger and more sustainable rise. The quality of the uptrend improves because it is driven not only by speculative buying, but also by purchases supported by fundamental reasons. This enhances price stability. In summary, the idea that the third wave should reach the 2.272 level is a very strong argument in technical analysis. When this level is reached, an increase of around 80% fits perfectly with the nature of the third wave, investor psychology, and Fibonacci principles. This is why, in such a scenario, the rise is seen not merely as a possibility, but as a strong probability. The third wave opens the door to major gains by combining investor confidence, market volume, and price momentum. As the price moves toward the 2.272 level, it signals both technically and psychologically the beginning of a new era. For this reason, when the third wave begins and the price heads toward this level, for most investors, this stage can be the most critical step toward financial freedom. Because an 80% rise is not only about reaching a technical level, but also a period in which investors' hopes, beliefs, and confidence in the market are rewarded. The power of Elliott wave theory lies here. It reflects not only price movements, but also human behavior and collective psychology. The price reaching the 2.272 level becomes one of the clearest confirmations of this theory.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.